So today we are doing a deep dive into a recent crypto market digest. Our mission is to really figure out how this staggering $40 trillion U.S. debt load is just fundamentally rewiring global finance.
Yeah, it's a massive shift.
And specifically institutional Bitcoin demand, right? Because, I mean, let's unpack this with a scenario.
Yeah.
Like imagine you max out a credit card.
Right.
Normally you just, you pay it down. But what if you just open a brand new credit card, use it to buy your old debt, and tell your family, like, hey, look, I fixed the budget.
I mean, most families wouldn't fall for that.
Yeah.
But structurally speaking, that is exactly what's playing out at the highest levels of government finance right now.
Right, because the national debt just crossed $40 trillion.
Yeah.
And those 30-year Treasury yields are hitting, what, 5.3%?
Yeah, matching the 2007 financial crisis.
Wow.
So to counter that, Treasury Secretary Scott Bessent announced this massive $4 billion a day bond buyback program.
Starting September 9th, yeah.
Right. And the mechanics there reveal a lot because they aren't magically wiping away the debt.
They're just shuffling it.
Exactly. They fund these repurchases by issuing short-term debt. So they are basically just adjusting the maturity profile to suppress those really high long-term yields.
Wait, hold on. Break that down for me, though. How does issuing short-term debt actually fix the long-term borrowing costs?
Well, it doesn't fix it, it just delays it.
Bro.
By buying back the long-term bonds, they artificially boost demand, which lowers the yield. But they pay for that with short-term Treasury bills.
I see. So the total load stays exactly the same.
Totally the same. They just swap a 30-year mortgage for a 6-month loan, so the interest rates look, less disastrous on paper.
Okay, so if the government is just, financial engineering their way out of this, Wall Street must see right through it. How are capital allocators protecting themselves?
They are aggressively hitting the debasement trade. When debt expands through tricks instead of actual economic growth, institutions instinctively look for non-sovereign stores of value.
Which is why we saw those spot Bitcoin ETFs absorb like $2.6 billion in just 7 days.
Exactly. They're using a fixed supply digital collateral to hedge against all this fiscal strain.
I do want to push back a bit here, though, based on the digest. If institutions are so wildly bullish on the asset itself, why did Bernstein analysts just slash their target for MicroStrategy down to $350?
Right.
While simultaneously saying Bitcoin is going to hit 150,000 by mid-2027, shouldn't a rising tide lift all the proxy boats?
It used to. But we are seeing a structural shift in how capital is allocated. Institutions realize they don't actually need corporate equity risk anymore.
Because of the ETFs.
Right. Why hold a corporate proxy, which comes with its own, operational risks or leadership variables, when ETFs just give you pure digital collateral?
Right. They just want the raw balance sheet protection.
Not a leveraged tech stock.
Yeah. And technically speaking, Bitcoin is hovering around 79,000 right now, facing resistance just under 80,000. It really needs to break 82,000 to validate that bull market reversal.
Right. The technicals reflect that hesitation.
But assuming they just want the raw asset, they don't want it just sitting there, right? I mean, with billions flowing into the base layer, the infrastructure has to evolve to put that capital to work.
And that is exactly what the Stacks Network's recent POX5 upgrade is doing.
Oh, right, the Bitcoin bonds.
Yes, Bitcoin bonds.
So how does that function for an actual investor? Is it like putting your physical gold in a vault where you keep the key, but somehow you still get paid interest?
That is actually a perfect metaphor. Historically, to get yield on Bitcoin, you had to wrap it.
Like send it to Ethereum or something.
Right, which introduces counterparty risk. If that bridge gets hacked, your Bitcoin is gone.
Yikes.
But the POX5 upgrade uses native cryptographic scripts, so your Bitcoin stays securely locked on the base layer. You hold the keys, but you generate STX token yields without that traditional bridge risk.
Oh, wow. So we are essentially watching Bitcoin transition in real time from this passive digital gold into a really active yield-bearing settlement layer.
A settlement layer that traditional banking is actively co-opting.
Wow, really?
Yeah, while the open source developers upgrade the base layer, TradFi giants are building compliant, regulated rails directly on top of it. South Korea's Shinhan Financial just partnered with Visa to develop stablecoin and AI settlement models.
Right, and Revolut is rolling out that you are euro-backed stablecoin across Europe.
Exactly. They are anchoring digital liquidity straight to domestic banking infrastructure.
So the legacy system isn't fighting the network anymore. They're moving in.
Yeah.
So for anyone listening, your fiat savings are basically caught right in the middle of this macro tug of war. If you want to see where this is going, watch Fed Chair Kevin Warsh at the Jackson Hole Symposium and keep a close eye on those September 9th Treasury buybacks.
Oh, absolutely. The resulting inflation signals and real yields will dictate exactly how fast institutions move into this new architecture.
Which leaves a pretty massive question to mull over. We have giants like Visa and huge traditional banks building compliant stablecoins on these networks, right?
Correct.
But at the exact same time, open source privacy developers like Tornado Cash's Roam and Storm are facing 2027 criminal trials, literally just for publishing code.
It's a huge paradox.
It really is.
Yeah.
If traditional finance completely takes over this crypto infrastructure to build highly regulated, surveilled settlement rails, will the foundational ethos of financial privacy even survive? Or is it just going to be regulated out of existence entirely?